tired watching a hunk of your cash go out the window year in and year out in the form of paying taxes to Uncle Sam? Well, I have some news for you. Today I want to present you with 7 tips as far as tax planning is concerned that could potentially make a significant impact in your ability to keep some cash back in your pocket. The first thing I want to hit on today is I want to talk about maximizing your retirement plan contributions. If your employer at work offers you a 401k, a 403b, or a 457, please take full advantage of that. The maximum contribution for 2024 is $23,000. And if you're over the age of 50, you can add an additional $7,500 to that in the form of a catch-up. If you do not have the ability to contribute to an employer-sponsored plan, feel free to take advantage of an individual retirement account. The maximum contribution rate for 2024 for an IRA is $7,000, and if you're over the age of 50, you can add an additional $1,000 for the catch-up there. The next thing I'd like to hit on is taking advantage of tax-preferred medical accounts such as HSAs and FSAs. For those of you who are not familiar with those terms, an HSA is a health savings account. Within an HSA, your contributions go in pre-tax, and then the earnings grow tax-free as long as they are used for qualified health expenses. The third strategy I'd like you to be aware of is tax loss harvesting. And tax loss harvesting encompasses selling assets that might be at a loss in comparison to when you originally bought it, with the hopes of offsetting any potential gains or even a small portion of income for the year. The fourth area I want to cover has to do with philanthropy, and the first part of that being donating highly appreciated assets. This is a great way to potentially lower basis and get rid of highly appreciated assets over time for a good cause. The second area would be to donate to a donor-advised fund, in which case you receive an immediate deduction for any contributions, which can then later be donated to the charity of your choice. And the last area I'd like to hit on, for those of you who are of the age where you're currently taking required minimum distributions, is to take a qualified charitable distribution from your retirement account. Here, you could take up to $100,000 and donate to the charity of your choice, and it does not get added to your earned income for the year. Fifth area, and one that is definitely very important, is estate planning. And 2 things that you can do here in thinking of your taxes over time is number 1, gifting. Staying below that gift tax exclusion over time and gifting to those that are very important and special to you in your life. Secondly, establishing a trust. Moving money into trusts over time will take that money out of your taxable estate at the time of passing. Sixth, just a regular review and monitoring of your withholding. It doesn't hurt to check with your accountant over time to make sure that your withholdings are done correctly, especially if you have multiple jobs. And finally, 7th, tax-efficient investing. Choosing assets that are tax efficient, so over time you're not incurring any unwanted, unnecessary capital gains or tax ramifications that are ultimately out of your control. Hey everybody, just want to say thank you again very much, and if this was of any interest to you or you found any of this helpful, please feel free to visit us at www.rocklinewealth.com, and we'd love to further the discussion. This is not tax advice, and I ask that you please consult a tax professional for your specific situation.